Hey guys, Flanagan here, checking in with you today about monetary policy. So I'm going to split this topic into two videos. The first is going to be just kind of an overview of the Federal Reserve and the graph that we associate with it, the money market graph. The next video is going to be a deeper dive into the actual tools that the Federal Reserve uses to conduct its monetary policy. So before we get jumping into monetary policy, we want to take a brief detour and recap fiscal policy. If you pause this and you can answer these couple of questions, then skip forward a couple of minutes. If you pause this and you can't answer them, then you'll want to listen in for this brief recap. And then on the next slide, I'm going to pop up a video that you can check out for a little bit deeper of a dive. So the two tools of fiscal policy are government spending and a change in taxes, both things controlled by the government. This fiscal policy is the attempt of the federal government to solve recession or to solve inflation through taxes and government spending. So if the government wants to solve recession, it should lower taxes so consumers have more money, or increase government spending, which helps create jobs and gives money to those workers. In order to fight inflation, the federal government should raise income taxes, which would take money out of the hands of consumers and slow down their spending, or decrease government spending, which would decrease job growth, and we would have a negative change in unemployment. So what curve shifts when fiscal policy is used? If taxes increase, that takes money away from the consumer. They do less spending, so aggregate demand would shift to the left. If taxes decrease, that means consumers get more money in their paychecks, so AD would shift to the right because of the increase in consumer spending. Finally, down there at the bottom, if government spending increases, that leads to job growth, job creation, and more money circulating through the economy, which would shift AD to the right because G is one of the shifters of aggregate demand. Now, this is just a recap, and that's where this little video is going to pop up in the top right corner. This is just the who, what, and how of fiscal policy you can pause and take a look at here. This is also something I'm not going to read all the way through. Pause this if you need to and take a look at sort of the chain reaction for expansionary fiscal policy and contractionary fiscal policy. Expansionary would solve a recession or when we are below full employment. This is overwhelmingly the most common scenario on AP test, multiple choice questions, and FRQ. Almost always FRQs have you use some expansionary tool instead of a contractionary tool. Multiple choice, there's a bit more of a mix, but again, I would say give a slight edge to expansionary. And really, if you know expansionary, you know that the opposite is contractionary. So if you really dig in and remember expansionary, you can just flip it to deal with contractionary, which is down here. So this just gives you the impact of these two tools on consumption and government spending and how that affects AD. And then when we shift our curve on the ADAS graph, what happens to price level, GDP, and unemployment. So these are the two graphs that relate to fiscal policy. ADAS, whether we're starting at recession, depression, long-run equilibrium, or beyond full employment, doesn't matter. Fiscal policy could apply to any of those scenarios. And then also loanable funds market, the LFM, where if we are in a recession, the government cannot raise taxes in order to spend money, because if it raises taxes, that's going to hurt the consumers, which would shift AD further to the left into a depression or a worse recession. So they jump into this loanable funds market where the government borrows a ton of money, which raises the real interest rate. And since real interest rates go up, that means businesses and consumers do not want to get loans. So consumer spending and business investment is slightly crowded out by government spending. So it's still overall a positive effect, generally speaking, the G increase, but there is a slight jump backwards, and we call that the crowding out as a result of consumer and business spending decreasing a little bit. And also a little video popped up here that you can take a deeper dive into loanable funds if you check out that video. So today's topic is the Federal Reserve. You already did a bit of reading on that, so I'm not going to read this to you. Basically, the Federal Reserve is largely independent of the federal government. It is not directly tied to any part of the US government beyond the president appoints members to the Board of Governors, and then the members of the Senate confirm. So that's the only direct check and balance, unless some sort of crime is committed. It's weird because any money, any actual profit that it makes, it gives directly to the US Treasury, which is part of the US government. It has the same goals as the federal government does. It's not like one is going to want to contract while the other wants to expand, but they use different tools because the Federal Reserve is not the same thing as the US federal government. So it's not subject to a ton of direct oversight, like it says here. This is just a map of the different actual Federal Reserve banks, the major ones around the country. You can see them numbered here. Little black squares are sort of minor or other regional Federal Reserve banks. So this is our zone here, Region 12. That means this Federal Reserve area is controlled by the San Francisco Federal Reserve, and I shouldn't say controlled, more monitored by. So the Federal Reserve in San Francisco is going to monitor the economic well-being of this region, and then they will all report back to the Federal Reserve on the East Coast over here. And so each of these regions report back, and they put together this big picture of economic health in the United States. And you can actually, there's other regional branches, like there's one in LA that you can take trips to and visit a couple times a month. They are open to tours and to the public. So what's going on in our region could be very different than what's going on over here in Texas and parts of Louisiana, but it's the job of the Board of Governors to compile all these reports and figure out what do they want to do. Do they want to help the economy grow? Do they want it to shrink? Or they just kind of hold steady and see what happens? So this again, just a recap of why it is strange. These are the three functions though. The Federal Reserve is a bank for the government. It is a bank for banks, meaning commercial banks like Wells Fargo or Chase. And then it also, its major function is to determine the country's monetary policy and influence money supply. So these are the functions that we'll get to in the next video, but this is just a brief introduction. These are the three major functions of this Federal Reserve. The big one we want to take a look at is monetary policy. So monetary policy is when the Federal Reserve, not the federal government, influences or adjusts the money supply of a country in order to address a particular economic problem. This is controlled by the Board of Governors of the actual Federal Reserve. It is not up to one individual person, though it is sort of commonly stated that the chairman or chairwoman of the Federal Reserve is arguably one of the top 2 or 3 most powerful people in the country beyond the president because of the influence that that person has over interest rates and bonds and things like that. So that's all I'm going to say about the Federal Reserve for right now, because I'm going to post up a video on the Google Classroom post that does a great job of giving an overview of the structure and the processes, and there's no point in me just repeating that. What I'm going to focus on now is the actual money supply issue. So money supply is how much money is available and circulating in our economy. This graph that's coming up, the money market graph, we really focus just on the supply curve. And before I show you the graph, this is just a brief overview of it. So many Dorito bags because it is a big deal for monetary policy. This basically shows, this graph will show how the Federal Reserve influences monetary policy, or the money supply, I should say, by either shifting to the right, which is an increase, or the left, which is a decrease in money supply. That shift will influence interest rates. Now, we're going to label it something a little bit different than the Loanable Funds Market. If you want to read about why we label it differently, that's right down here, and you can, but I'm not just going to read that out to you. I'm going to jump right into the graph. So this is the money market graph. We label up here nominal interest rate up on the y-axis. You can abbreviate it NIR if you like. And then down here we have the quantity of money. So again, this is like an old school supply and demand. We have interest rate, which is the price of getting a loan, and here the quantity of money. So just like P and Q, our demand curve right here is downward sloping because, as we know, if interest rates are high, the quantity demanded of money is pretty low. The supply curve is what 99.5% of FRQ and multiple choice questions will ask about. The supply curve is weird, and we can abbreviate it SM for supply of money because it is entirely vertical, completely vertical, just like LRAS. It's not related to LRAS, but it is vertical like that. This curve is entirely controlled by the Federal Reserve. That's why it's vertical. Consumers don't really have an effect on that. The supply of money curve only shifts as a direct result of an action by the Federal Reserve. Demand for money can change based on some different scenarios, but the supply of money can only change based on an action of the Federal Reserve. So these are the shifters. Again, not going to read verbatim on here. The things that will shift the supply curve are one thing that we already know, the required reserve ratio. We'll get to that in the next video of how the Federal Reserve uses it. But these are the three shifters of the supply of money curve, the vertical one. The required reserve ratio, the amount of money that banks are required to keep in the vault, and then something called the discount rate, which we'll get to in the next video, and then open market operations, which you were briefly introduced to when we looked at banking and the bank balance sheets. That's just, again, the buying and selling of bonds. Again, this is the reason why it's completely vertical. Here, unfortunately, there's a typo, and I'm not going to restart all the way back to the beginning of this. This should say, think of the demand curve as cash or currency, and then read this down here. The example for what could shift the demand curve that I've seen on AP tests before is basically what happens to the demand for money when credit and debit cards were invented. Well, when we have credit and debit cards invented, you can use those instead of keeping cash on you all the time. So the demand for money, or cash in this case, decreased because there was another alternative out there. And to show a decrease, you would just shift demand to the left like any other shift. A leftward shift is a decrease, a rightward shift is an increase. So if interest rates are high, the opportunity cost of holding cash in your pocket is high because you could be earning that higher interest rate if you had your money in an account somewhere instead of in your pocket. So if interest rates are high, the demand for money is low because people want to be earning that higher interest rate, so they'll be putting it into bonds and other types of investments instead of holding on to cash. So this is just a quick multiple choice sample question. You can pause it and read it. The amount of money that the public wants to hold in the form of cash. Take a minute, see what you think. Pause it right here if you don't want to see the answer. The answer here is C. The amount of money that the public wants to hold in cash will decrease if interest rates go up. Because again, if interest rates are high, you could be earning a lot more interest if you put your money into some sort of investment instead of keeping it as cash. So that's just a check-in on the demand side, nothing else on the demand. So again, we're going to focus on the supply here. This is going to show you a sample shift of the supply of money curve, the completely vertical one, which again is entirely shifted by the Federal Reserve doing one of three things. So we'll just say if the Federal Reserve wants to increase the supply of money, they have three things that they could do, which we'll get into the next video. But if they increase the supply of money, this is what it would look like. We would shift here from SM, shift it to the right to show an increase like everything else, and that would represent an increase in the money supply. So if the supply of money increases, this was our original nominal interest rate. Our new, after the shift, equilibrium interest rate decreased. So nominal interest rates decreased when the supply of money increased. If we want to see what a decrease in the supply of money looks like, we just do it the opposite direction. Here we have the supply of money. If the Federal Reserve uses one of its three tools to decrease the supply of money in the United States, then we would shift it to the left, and we would relabel our new equilibrium here at N2, and I should move this label. This Q2 should be over here instead of kind of hanging out in space with nothing around it. So as a result of the Federal Reserve decreasing the supply of money, nominal interest rates increased. And we'll get into the effects of that on the next video and sort of another chain reaction idea. But for now, as the cartoons say, that's all, folks, and we'll check in with you next time.